Let's say you've got $10,000 sitting in your bank account. Not doing much, just sitting there, slowly being eaten alive by inflation. Now, you've heard about the share market. Maybe a mate mentioned it. Maybe you've been scrolling late at night, seeing people talk about ETFs and franking credits and compound returns, and you're thinking, should I be doing this? Well, today I'm going to walk you through exactly how I'd build a $10,000 ASX portfolio if I was starting from scratch, right now, in 2026. No hype, no rocket emojis, just a real practical plan you can actually follow. Let's get into it. Before I touch a single dollar, I want to be straight with you about something. Investing isn't a lottery. It's not about finding the next big stock that's going to 10 times overnight. That's gambling. And gambling is fun until it isn't. What investing actually is, especially for beginners, is putting your money to work slowly, patiently, and consistently over time. The ASX, the Australian Securities Exchange, has returned roughly 9 to 10% per year on average over the long run. That includes the crashes, the GFC, COVID, everything. What that means in real terms, if you invest $10,000 today and leave it alone for 20 years at 9% average returns, you'd end up with around $56,000. You put in $10,000. You walked away with $56,000. You didn't do anything clever. You just didn't panic. That's the game. Boring wins. So with that mindset locked in, here's how I'd split up that 10 grand. I'm going to split this into 3 buckets. Think of it like a core, a growth layer, and an income kicker. The first $5,000 goes into VAS, the Vanguard Australian Shares Index ETF, full stop. VAS tracks the top 300 companies listed on the ASX. When you buy VAS, you're essentially buying a tiny piece of Australia's biggest businesses: Commonwealth Bank, BHP, CSL, Wesfarmers, Woolworths, all in one trade. It's the most popular ETF in Australia for a reason. It's simple, it's cheap, and it works. The management fee is just 0.07% per year. That means for every $5,000 you invest, you're paying roughly $3.50 a year in fees. That's less than a flat white. Now, VAS does have a heavy lean toward financials and resources, the big banks and mining giants. That's just the reality of the Australian market. But for a foundation, it's hard to beat. Why 50%? Because you want your base to be solid. This is the boring engine that keeps ticking. Next, $3,500 goes into IMVV, the iShares S&P 500 ETF. Here's the thing about only investing in Australia. We're a great country, but we're also about 2% of the global share market. That leaves 98% on the table. The S&P 500 is 500 of America's largest companies: Apple, Microsoft, Nvidia, Amazon, Alphabet. These are businesses that operate globally, generate billions in revenue, and have been driving the world's economic growth for decades. IVV gives you access to all of that. One ETF listed right here on the ASX, so you can buy it in Australian dollars. Over the past decade, the S&P 500 has genuinely outperformed most global markets. Now, past performance isn't a guarantee, but having global exposure alongside your Australian base just makes your portfolio more resilient. $3,500 here. That's your 35% global engine. And then the final $1,500 goes into VHY, the Vanguard High Yield Australian Shares ETF. This one is interesting because it does something slightly different. VHY focuses on the 60 to 70 ASX companies with the highest forecasted dividend yields. Think major banks, Telstra, Woodside Energy, businesses that pay out regular dividends. Historically, VHY has offered a yield around 1 to 2% higher than the broader market. And in Australia, thanks to our franking credit system, those dividends often come with a little tax bonus attached. That's a genuinely unique advantage we have as Aussie investors that people in most other countries simply don't get. This slice of the portfolio is your income layer. It's not flashy, but it pays you while you wait. $1,500 to start. As you add more money over time, you can scale this up if passive income is your goal. Now, where do you actually buy these ETFs? A few platforms worth knowing about for Australian investors: CommSec, backed by Commonwealth Bank. Very safe, very trusted. Brokerage fees are a bit higher, but for beginners, the interface is clean and easy. Superhero, popular with younger investors. Lower brokerage fees and you can start with smaller amounts. Self-Wealth. Flat fee brokerage, which is great once your portfolio grows bigger. Whichever platform you choose, look for two things. Chess sponsorship, that means your shares are held in your name, not just the broker's. Get in a clear, simple fee structure. Please note, I'm not a licensed financial advisor. This is general information, not personal financial advice. Before investing, it's worth speaking with a qualified professional who understands your specific situation. Real quick, let me save you from the mistakes I see most beginners make. Mistake 1, waiting for the right time. There is no right time. People have been saying the market is about to crash for literally decades. The best time to invest is when you have money. The second best time is also when you have money. Mistake 2, checking your portfolio every day. This is a trap. Watching the numbers go up and down every single day will mess with your head. Set it up. Check it monthly at most. Let it breathe. Mistake 3, putting everything in one stock. Look, I get it. You hear about some mining company that doubled in 6 months and you want in, but this is how people lose money. Diversification exists for a reason. Mistake 4, panic selling during a crash. Every market downturn in history has eventually recovered. Every single one. The people who got hurt were the ones who sold at the bottom because they were scared. The people who came out ahead were the ones who did nothing, or were even better, kept buying. Here's the bit most finance videos skip over. $10,000 is a great start, but the real magic happens when you keep adding to it. Even putting away an extra $200 or $500 a month on top of your initial $10,000 changes the outcome dramatically over time. This is called dollar cost averaging, and it means you automatically buy more when prices are low and less when prices are high. It smooths everything out. The people who build real wealth in the share market aren't the ones who made one brilliant trade. They're the ones who showed up consistently for 10, 15, 20 years and never stopped. That's the plan. Simple, repeatable, proven. So, to recap, here's the $10,000 ASX portfolio I'd build today. $5,000 in VAS. Your Australian Foundation. $3,500 in IVV. Your Global Growth Engine. $1,500 in VHY. Your income and dividend layer. 3 ETFs. Low fees. Massive diversification. And a strategy that works whether you're 22 or 52. If this video helped, drop a comment below and let me know. I'd love to hear what questions you have about getting started. And remember, this is general information only. Please do your own research and speak with a financial advisor if you need personalized guidance. Catch you in the next one. Subscribe, bell on, and I'll see you in the next one.